Hey everyone, welcome to the channel. I'll be using this channel to share my investing journey, strategies, movements in my portfolio, and general thoughts on the market. If you want to follow along on my investing journey and see more content like this, hit that like and subscribe button. It goes a long way to helping this channel grow. Alright, let's dive straight in. Today I'll be giving you an update on how my portfolio has been performing and share my thoughts on a few stocks I'm planning on increasing my position in. Overall, the portfolio is up over 34% since I started it. Some of my key positions have done really well, like Fortinet, which is up over 40% since I entered the position around 7 months ago. Meta has also gone up around 26% in the last 6 months. I've also recently taken up a position in Paycom, which is currently down around 5%. I think that this is just some short-term price action. If it drops down further, I'll start to consider adding to my position at a cheaper price, provided that there are no negative changes to their fundamentals and the future outlooks of Paycom. Now let's talk about the exciting part, the 3 stocks I'll be buying next. These are companies that I believe have strong fundamentals, good long-term growth potential, and are trading at what are, in my opinion, reasonable valuations considering their growth prospects, returns on capital, and historic valuation ranges. This is going to be a high-level overview of why I'm buying these companies. I will do a deeper dive into the investment theses of these companies in a separate video. And to help illustrate the fundamentals of these businesses, I'll use my website investmenthorizon.io. The first buy that I'm making is Alphabet, the parent company of Google. Starting with their growth, Alphabet's earnings per share has grown at an impressive average of around 20% annually over the last few years. This demonstrates the strength of their operations, which includes online advertising through Google Search and YouTube. These 2 divisions continue to drive substantial revenue due to their dominance in digital ad spending globally. Additionally, their Google Cloud division is increasingly becoming a larger contributor to top-line growth as businesses move towards cloud-based solutions. This division has been showing strong double-digit growth and is well positioned to capitalize on the global shift to cloud and AI integration. Looking at profitability, Alphabet's management are reinvesting profits into projects with high returns. Their return on capital has exceeded 20% over the last few years, and is an indicator that the company is allocating resources efficiently to drive future growth. This includes investments in data centers and AI research, which I believe will strengthen their long-term competitive advantage. Now for the valuation, Alphabet's price to earnings ratio is around 21, which is at the lower end of their historic range. While I generally prefer to look at the free cash flow per share ratios over the earnings ratios, Alphabet's been doing heavy capital expenditure on data centers for AI and cloud, and these are temporarily inflating these ratios. I think these investments are strategic and essential for sustaining a competitive advantage, and when they start paying off, I expect they'll generate significant returns, particularly from their AI and cloud businesses. The second company I'm adding to is Meta. Its core platforms, Facebook, Instagram, and WhatsApp, are incredibly robust, with billions of active users driving engagement and ad revenue. Over the past few years, Meta's free cash flow per share has grown at an impressive average of around 30% annually. This growth stems from increasing ad impressions, higher average ad prices, and growing activity across its platforms. Meta has also been leveraging AI to improve ad targeting, which enhances the value it offers to advertisers. For example, AI-driven tools are helping generate personalized content and improve ad performance, which I expect will continue driving ad spend on Meta's platforms. Management are effectively reinvesting profits back into the business and are able to achieve a stable return on capital around 20%. This is a strong indicator that they're deploying capital in areas that are accretive to shareholder value. In terms of valuation, Meta is trading at a price to free cash flow ratio of around 27. While this is slightly higher than Alphabet's price ratios, I think It reflects Meta's faster growth expectations. Looking at the range that Meta has historically traded at, this ratio is also at the lower end of the historic range. This, in combination with the strong return on capital and higher growth expectations, are part of the reason that I'm increasing my holding in Meta. The third company I'm increasing my position in is Mastercard. This is a business with one of the strongest economic moats I can find in the market, thanks to its global payment network. Mastercard is a clear beneficiary of the secular shift towards digital payments, which continues to grow as the number and value of digital payments increases. When it comes to growth, Mastercard's free cash flow per share has grown at an average of 13% annually over the last decade. This consistent growth is driven by rising transaction volumes, increased adoption of digital wallets, and geographic expansion into underbanked regions. Looking ahead, I expect Mastercard to maintain stable growth, especially as they expand their service offerings. Their return on capital exceeds an impressive 40%, showcasing the scalability of their business model and the high margins they generate from each additional dollar of revenue. This metric highlights how efficiently Mastercard can generate returns for its shareholders. As for valuation, Mastercard's price to free cash flow ratio is currently around 33, which might seem high at first glance, however, is in line with their historical trading range and reflects the premium that a high-quality business like this commands. Considering the returns the business is generating and their growth prospects, I believe the valuation is justified, especially when viewed over the long-term investment horizon. That's it for today's video. If you found the stock analysis helpful, check out investmenthorizon.io for even more insights and data on these companies and many others. The link is in the description and you can try it out for free. It's a great way to support the channel. Thanks so much for watching, and I'll see you in the next video.